Yo, what's up, guys? The stock market is not doing so good right now. Our main taxable account, our Robinhood portfolio, is down 2.81% on the day. I got on my McDonald's shirt. I actually worked at McDonald's, believe it or not, a couple years ago. But anyway, look at this right here. McDonald's is now my largest holding. It's over $4,000. And here's why that's not a good thing. That means my old largest holding, Carlyle, right here. Look at them the past, 3 months right here. They're down 20% basically. And that's just our Robinhood account. Let's go over to our Moomoo account right here. We're down $373 in here, which is 3% of this portfolio. So check this out right here. If we look at our holdings right here, every single holding is down on the day. This is not good. So I actually did buy one stock in here today, and I'm actually going to be doing in this video an analysis on my top 3 favorite stocks of all time. Believe it or not, right now, I this will be a bold claim, and one of the stocks I'll go ahead and show you that I bought. We'll do analysis on this one last because this company will surprise you, and I believe now is a really good time to buy them. Not financial advice, nothing in this video is. Look in the top middle here. They're trading at nearly a 25 PE ratio, which is actually pretty fair, 25 PE. That's like a fair value for a stock. That's not overvalued. That's not really undervalued either, but I think they're a pretty fair price to buy into them. We are down 10% on our position. And the first stock I actually want to go over in this video to do a full analysis on them is Powell Industries. Believe it or not, this company, I believe, is back in buy the dip territory. Look at the PE ratio right now. They're trading at 13 times PE with no debt whatsoever and nearly 400 million of cash. And check this out, I'm actually up like 100% on my shares. So technically, I bought this company based off right now's PE ratio. I bought them at like a 6 or 7 PE ratio, adjusted on my cost. But right now, a 13 PE ratio, let me show you all the numbers for yourself. You can draw your own conclusion around this company because they're one of my largest holdings for a reason. They're a dividend growth stock. They actually have a 6 or a 0.6% dividend yield. Nothing crazy. Look at the forward PE ratio. It's a 12.77. The forward PE ratio is lower than the trailing 12 months PE ratio. That's because the earnings are expected to grow. So this company is expected to keep on improving their net income, yet they're going down in stock price. I think it's just momentum because they have had a pretty incredible rally since 2019. But look at the net income they're making. This is a very profitable company. Literally just in the most recent quarter, they made 34 million, and that's up 44% year over year. Look at the top line sales. This is incredible. Sales are up 24%, operating income's up 37%. But anyway, let's look at this net income right here. Remember this number, they made 34 million of net income in the most recent quarter. Let's see how much their dividend costs. And again, the dividend's only 0.6%, but look at this right here. Only cost $3.2 million. If they wanted to, they could literally double the dividend or even triple the dividend to a nearly 2 to 3% yield. I think they'll get there one day. If you buy the stock now, one day you may, not financial advice, have a 2 or 3% yield on cost. And look at the cash they have on hand. It's on the left here, $373 million of cash. That's actually a record, or pretty close to $1 million off a record amount of cash. But anyway, $373 million of cash. And look at the total debt. They actually have no debt whatsoever. They don't owe anyone literally any money. And since they have so much cash and no debt, they're actually making a bunch of interest. In the most recent quarter, they made $3.8 million. And remember, the dividend only cost $3.1 million, so they literally made more interest on their cash than the whole cost of their dividend. Isn't that just crazy? That's why I think this one is a financials play. You buy this one for the fundamentals. They literally have no debt. Look at their retained earnings. They're retaining this money. It's at a new record. It's up 42% year over year. Powell Industries is one of my largest holdings for a reason. They're kind of a dividend growth stock, I think. So they have had an incredible couple years here, but the PE ratio is why I don't think this one's that crazy, overvalued. I think may be a good time to buy the dip on them. Sorry, I'm kind of fumbling my words here, but let me show you this next stock right here. All right, guys, so now I want to show you why this stock was my largest holding, and I promise you next time I get paid, I'm going to be buying at least one more share of this company. And we actually have a pending dividend of $12, so we're getting a $12 dividend, but look at our total return. We're literally break even. We're only up 0.32%. So that's the same as the dividend. We're up $12 and we're getting $12 a dividend. So that dividend, I guess, is the equivalent of 0.3%. So get a little 0.3% yield there. But anyway, let me show you the incredible incredible fundamentals of Carlyle. And look at the dividend. You get a 1.2% yield here. This is a phenomenal dividend growth stock. And look at the PE ratio. This is another one that trades at a very low PE ratio. Look at that. The PE ratio, I like to look at the forward one. It's a 16. So they're trading at 16 times forward PE ratio, which seems, pretty cheap to me. And look at the dividend right here. They're actually 1 year away from a dividend king. They have 49 years of dividend growth. They've never had to cut their dividend once, not during 2008, 2020. They've risen it every year, never had to cut it once. So anyway, right now the dividend is exactly $1 per share. So you get a 1.2% yield. And look at the EPS right here. We can look at the free cash flow per share. It was $8 in the most recent quarter. The EPS was $3.56. It's actually, they had a one-time adjustment that made their EPS go down. So look at the EPS right here. You see how it says it's down 15% year over year? Well, now let me show you the diluted normalized EPS. This is why I like to look at both metrics. It gives a little clearer picture. Look at this. It's actually up 2% year over year. So that's quite a big difference. EPS was down 15, but the diluted normalized EPS was up 2% year over year. So that's a good sign. And look at this right here. Here's how much cash they have. $753 million of cash. Look at how their cash just went down recently. If you're wondering, hey, why is their cash going down so much? This is why. This is the main reason why I own Carlyle. Not only for the 1% dividend growth, but look at the buybacks that they're doing. They spent $400 million just in the most recent quarter. They spent nearly $1.5 billion just in the past year buying back their own stock. So if we go to the total common shares outstanding, you now own 6.92% more of the company than you did 1 year ago. So if you add the buyback yield and the dividend, you're basically getting an 8% total shareholder return here. And let me show you again, their dividend only cost $45 million. So this one has a higher yield than Apple with the lower dividend payout ratio. Nearly a double, I think it has double the yield of Apple with the lower payout ratio. I'm not too sure, but anyway, dividend only costs $45 million. They're literally spending 10x on dividends. They spent $45 million on dividends, $450 million on buybacks. And look at their diluted weighted average shares again. You own 6% more of the company. Incredible stock. Like look at their gross profit. That was down 3% year over year. So I just like showing you the numbers for yourself. You can draw your own conclusion. Again, total debt of $1.89 billion. Look, their total debt just went down. Well, of course, they're making so much free cash flow. I've looked at this company's investor presentations so many times. They have a 25% plus ROIC, a 20% free cash flow to sales ratio, which means if you go and spend $100 at Carlyle, $20 of that or more is instant free cash flow for the company. So look at the free cash flow year over year. I do want to mention, for wondering why is it kind of declined, they just sold off a segment of their business for $2 billion. They sold off this interconnect business, a low margin business for $2 billion. So they had $2 billion of proceeds. They spent most of that on buybacks. But look at the total revenue. It is down year over year. That's explained by the sell-off. And that's kind of why their cash also went up so much. They actually sold off their business to ticker symbol APH. And this is another stock I am heavily, heavily watching. I would actually love to own this stock right here. And this is another dividend growth company. Look at this. You're getting exactly 1% dividend yield right here, 0.99% dividend yield. But look at this net income growth. Tell me this isn't super impressive. I mean, it obviously just went up, their net income, because they just bought that segment of business from Carlyle. That's kind of why their sales are up 29%. So it's not all organic growth. But look what it's doing. The net income is growing. So not only is the net income up 44%, the actual EPS is up 42%, and the EPS includes stock-based comp and all that. So they really are returning for the shareholder 42% EPS growth. And we can look at the free cash flow per share. This was actually flat year over year. Oh, if you're wondering why did it go down right here, they did a stock split, and this doesn't adjust for the stock split. So anyway, but that's why I like to look at the actual net income right here. Look how consistent they are with this net income. So anyway, let's actually do a dividend payout ratio on this. So in the most recent quarter, they made $752 million, or let's just call it like $600 million. They made $600 million on average. Dividend only cost $200 million. And look at that. They just rose their dividend by a huge amount. And that's why the cost of their dividend just went up, but they could easily afford that. $200 million a quarter. So anyway, that's what I like about APH. They do have growing net income and EPS, free cash flow per share. APH is a cool one. Oh yeah, look at InnoData right here. If anyone remembers, I've been kind of making some YouTube videos about this stock right here. incredible earnings. If we head over back here to our Robinhood portfolio, obviously, our main taxable account's not doing so hot, down 2.8%. That's actually more from like Constellation Energy. They're down like 10%. But look at our Roth IRA. We are actually up on the day in our Roth. So that's from InnoData right here. They're up 20% on the day. Hey, if y'all remember, I also just made a video about Monster again. I bought one share of Monster. Ever since that video, the stock is up 15%. That might have been also with Celsius. I think Celsius had an incredible rally today. Dang, Build-A-Bear Workshop not doing so hot. They're down 5% on the day. Build-A-Bear Workshop has surprisingly good fundamentals. It's really weird because I don't like their business model like Build-A-Bear Workshop, but the financials are so good. The PE ratio is so low. They're a buyback machine. Like, I might do a whole video later on Build-A-Bear Workshop. And then here's another stock I want to share with you that I'm going to add to my Roth IRA probably. This is Yelp right here. And this is the last stock I want to go over. And I promise you this stock will impress you. If it doesn't, then feel free to hit the dislike button. And again, I do own 14 shares of this one, so I might be biased, but we just went negative on our position. And here's why I think now is the perfect time to buy them. Look at this net income growth, or even the operating income. This is real profits. They actually just hit a record operating profit, half 100 million. I don't know why I was going to say that, but they made $53 million. Actual, let's just look at net income though. So they made 42 million of net income. What is Yelp doing with 42 million of net income? Because remember, they have no debt. They don't pay a dividend either, but they have no debt whatsoever. Y'all aren't going to believe this. They spend so much money buying back their own stock. And you may be saying, oh, only 50 million, that's not that much. The whole stock is only worth $2 billion. So they spent 200 million on buybacks. Guess what? Well, that's the total common shares outstanding. If you go to the diluted weighted average shares, you now own 10% more of the company than you did 1 year ago. So that's the diluted weighted average shares. There's only 67 million shares. There used to be 75 million. Same with total common shares outstanding. Right now it's 65 million. If we zoom out, they're always buying back their own stock. So Yelp is a shareholder-friendly company. Again, the actual top-line sales are only up 5% year over year. So maybe people won't like that. They only have 5% sales growth, but look at the net income growth and operating income growth. What does that mean? They're expanding their margin. It's growing faster than 5%. So yeah, look at this net margin right here. It's growing, look how choppy it used to be. Sometimes they would lose money some quarters. It got really choppy, but look at how consistent they are. And this consistency really makes me like the stock. And they may even in the future pay a dividend one day. I think they're also in a good spot to maybe even buy another company, or someone could even buy Yelp. So look at their cash right now. Again, they have no debt, 300 million of cash. And their cash is going down because of all the buybacks that they're doing. I believe they think the stock is at a good valuation. That's why Yelp is buying back their own stock. They think it's at a good valuation. And Yelp has actually been flat for look at this. Wow, Yelp has been flat since 2016. So again, always do your own research. Could be risk, but I like the buybacks here. I still like that the sales are growing. I'll get it, only single digits, but if they acquire a company or something, or someone acquires them, I believe they could maybe go back to double-digit sales growth. So anyway, that was the video. I hope you enjoyed. If you did, please drop a like on the video. It really does help out the channel. And if you leave a comment, I'll make sure I respond to all of them. But yeah, that was the video. I mainly wanted to go over Carlyle. Yeah, look at all our other stocks. Constellation Energy's down 10, Salesforce 3, Google. Actually, Zoetis, our healthcare plays up. We got a small $5 dividend from them. But anyway, I really appreciate you. Let me know your thoughts on Powell Industries. Give me an honest analysis on Powell Industries. Also, I forgot to mention, they have over $1 billion backlog of orders. They have a $1.3 billion backlog of orders that they haven't fulfilled yet. Market cap is $2 billion. If we look at their net income right here, or their net margin, 15% net margin on $1 billion of sales. Anyway, Powell Industries, great company. Let me know your thoughts on them or any of these stocks. Let me know what you're buying. Oh, and I guess I kind of forgot to go over Comfort Systems stock. You know what? We'll do that in another video. This one's getting a little long, but let me know if you like the longer videos. Hope you, I've already said the outro, but see you later. Thank you.